There are some myths surrounding credit and what works, what doesn't work, what you should have, what impacts your score, what doesn't, that I want to debunk in this video. They're right on your screen. All credit is created equal. Closing all old accounts will improve your credit score. You must carry debt in order to build your credit. Love that one. Paying off collections cleans up your credit. I see that one quite a bit. The higher the credit score, the better it is. And then personal credit doesn't affect business credit. So, with that in mind, let's just go ahead and dive right into the first myth. All credit is created equal. This couldn't be further from the truth, ladies and gents. All credit is not created equal. There's two forms of credit. You have revolving credit lines, and then you have installment credit lines. I'm going to give you two real world scenarios. Revolving credit lines are things like personal lines of credit and credit cards, meaning if you have a $100 credit card and you pay off, let's say you have a $20 balance that's on it, and you pay off the $20, guess what? Next month, once that statement reports, that account essentially replenishes, and you now have access to, again, $100. That's known as a revolving line. But let's take a look at the other side, though, which is the installment credit lines. How does that work? Think of this kind of like an auto loan, a student loan, a mortgage, a personal loan. Those are all installment loans, meaning once you pay off a car, that is it. That goes off into your credit history as a paid off loan. In order for you to go back out and get an installment credit line or an installment loan, you would have to go out and reapply for that. Now, there's pros and cons to each of them. We're not going to break that necessarily down in this video, but the pros of revolving accounts is exactly what that sounds like. You can continually use that and increase those accounts. The pros of installment loans, those are used more for big lump sum payments, cars, boats, jet skis. If you maybe a good one that I've seen is if you have maybe a home that you're looking to repair, you can take out a loan against that so that you can raise the value of your property or of your properties. If maybe, again, you are looking to do more of an investing type of approach. But with that in mind, there's two types of accounts. You have your primary accounts, and then you have authorized users. Now, whenever I say accounts, credit lines, or trade lines, that's essentially used interchangeably. Sometimes you hear primary accounts, primary trade lines, or primary credit lines. Sometimes you hear authorized users, authorized trade lines, just so you know it's all one and one the same, right? Don't get too confused with the lingo here. So with primary accounts, these are accounts that belong to you, meaning you went out, you applied, you got the hard inquiry, you got your credit ran, and you were approved for said amount. On the authorized user side, though, this is typically used within a family dynamic. And so this actually was used for me when I was building up my personal credit. My dad put me on one of his Bank of America cards, which at the time was like maybe $21,000 on it. That helped fast track my credit profile, right? So it immediately shot up my credit score, which is what it's used for essentially right now. Now, you can use the authorized user approach in the building phase, but you don't just want to solely rely on it. This is why, again, all credit is not created equal. The way that it works is you'll use the authorized user or the authorized user approach, which is where you're kind of piggybacking off of maybe a parent's credit, a sibling, or a spouse or a partner. And you're going to use that so that you can, again, nicely, what I would say is this is like the easiest way to break it down is nicely give your credit a nice bump, nicely a nice cushion, so that you can then go in and get access to your own primary trade lines. Now, if you have more than 3 authorized users on your credit profile and you only have, say, one primary account, that's known as a thin file. And so authorized user accounts carry far less weight for future funding, whether on the personal or on the business side, as you, again, go into the banks or as you go in to get things like vehicles or mortgages. Banks, financial institutions, and underwriters, they want to see your own primary accounts. So, good rule of thumb is no more than two, three at the absolute most. Once you get to that threshold, that's when you want to, if you haven't done so already, especially if you're in the rebuilding phase of your credit, that's when you want to go back in and start working your way into three, four, I'd say minimum five primary trade lines added to your profile. That can come in forms of three revolving accounts, which are three credit cards, and then two maybe installments, which is maybe a personal loan or a student loan that counts as well that you're paying off on time, and also maybe an auto loan or even a mortgage, right? So either one of those, just kind of keep that ratio in mind. And then we have two sources of credit. These are bank issued credit lines or credit cards, and then you have store issued credit lines or credit cards. Now, sometimes people confuse this because they say, wait a minute, I have access to, say, a Macy's card, and it said that, it's backed by American Express, or there's like a little American Express on there. And so I have an American Express card. That's a store issued card. And so what ends up happening is that you'll get that card and you think that you have a financial issued card or a bank issued card, and that banks see that as one and one the same. It's not. And so the only products that are going to, again, work in your favor for, again, in the future, if you plan on buying homes, if you plan on getting vehicles at a good rate, if you plan on working your way into business credit lines, is by having bank issued cards. This means that you're applying directly with the banks, directly with the credit unions. Not saying that a store card, if you needed it for maybe a grandiose deal that you saw, even though I don't really find it much of a need outside of that, should you not get it, right? One of my first credit cards was a Best Buy card. I think I had, at the time, it was like, I think it was Synchrony. Synchrony Bank was underwriting them. It was either Synchrony or Capital One. This was a while ago. And I believe at the time it was like $500 off your next purchase if you spend more than like $2,000. I was going to spend more than $2,000. So at the time, that made sense because I was getting myself a laptop, right? Situations like that. But you still do very much so want to be careful because you don't want to get caught into a consumer cycle. But that would be the difference between a bank issued card, which again is directly with the bank's credit unions, and a store issued card. This is why all credit is not created equal. Now, we have closing old accounts. Closing old accounts. Is there such thing as closing an old account and it not affect your credit? Couldn't be further from the truth. Anytime you close an old account, it's going to affect the overall history of your profile. This is bad. This is no good. Banks like to see age and they like to see history, even if the amount is low. One of the biggest rookie mistakes I've ever seen done was from a friend of mine who had, I believe it was a 15-year-old American Express card. Got it back when he was in college. Only had, and I don't know why it wasn't higher. Maybe he just wasn't properly asking for credit limit increases, but he only had about $1,500 on there. Every other credit line he had was upwards of $15,000, $20,000. He decides to close the account. This is one of the first accounts he ever had. He decides to close the accounts because he said, man, I'm not doing anything with this card. There's no more perks to it, right? And what am I going to do with $1,500 when I have everything else that's like $15,000, $20,000, right? I could just make it on that purchase. He closes the account. He drops from a 760 to a 670 overnight when that went to go report that the account was closed. And so a good rule of thumb there is that even if you're not using the account, if it's over 5 years, sometimes, you can argue that. Some people would say if it's over 7 years. For me, if it's over 5 years, especially if your average is under 3 years old, don't close the account. Because if you have a credit line that's over 5 years old, even if it's only $200, and let's say again your average age is 3 years, you'll probably drop to about a year and a half, and now you drop to what's known as kind of like a thin file. I also refer to it as a baby file, and so you're just better off leaving it, even if you're not using that account anymore. Payment history is one of the largest shares of the total credit score that gets made up. And so that's right around 35% on the FICO. And so if you're, let's say, even if you've only been using the card maybe couple small purchases here and there, the moment you take that card off, like you lose the age. It's gone, right? The age and the payment history and credit utilization make up really the three biggest components of a credit score, or in this case, a credit profile. So unless you want bad credit and unless you want to suffer, and this is, self-inflicted suffering, which is never good, leave the account open even if you're not using it. Next myth that we want to bust here is you must carry debt. Now, this threshold that I'm giving you, that 2 to 8% rule, I actually got that from an underwriter many moons ago when I used to sell real estate. And I remember him saying, Irv, you want to keep access to at least 2 to 8% utilization on it because underwriters like to see that the card is being used and you want that reporting. And then I started taking a deeper dive into that. And I kind of saw where he was coming from. And I kind of see where this maybe ties into where people get this rule from, where you want to have some type of balance left on the account, because if not, then it looks like it isn't being used. Look, we have clients that have upwards of $500,000 worth of revolving lines alone, not installments, revolving lines alone. And I just started asking, dude, how much do you carry? Some of these people don't carry any debt at all. Now, I know that that may be counterintuitive, where you're thinking, why would you have access to working capital and not carry the debt? Well, some people don't want to pay interest. The whole purpose of having access to working capital is having it there. So in the event that you need it, you can tap into it. And you're also not wiping out your personal reserves, or you're not solely dependent off of an invoice getting cashed out in order for you to be able to keep operations alive. And so here's what we found out. And I started taking a deeper dive into this with underwriters that are issuing credit lines right now to businesses in real time. There is no evidence that carrying a balance is going to improve your credit. Here's why. This contradicts the entire rule of first principles, with credit utilization being a factor. Because let's be honest here, if the 30%, so you have 35%, which is your payment history, 30% is going to be credit utilization. And so if we start to all of a sudden carry a debt now, then that contradicts the entire scope of, hey, the lower the utilization, the better. So why would I carry a 2 to 8%? You're still going to have that amount report that it was paid off in full every month. So it's not like the payment isn't getting reported. It's still getting reported. You're just not carrying a balance, because two things happens when you do decide to carry a balance. Number one is your credit exposure starts to take a hit, meaning if the bank says, okay, our total credit exposure right now is, let's say, 100K. That's the max that's the max that we can, give this client. I'm going to use myself as an example. That's the most that we're going to give Irv is 100K. Every bank has their own credit exposure. We've done trainings on this, and I'll probably pin it in this video. But let's say it's 100K for the purpose of the example. If Irv decides to carry a 40% balance every single month, month in, month out, if I try to go back into that bank, they're going to say, wait a minute, dude, why are you coming back in here? You've already gotten approved for, let's say, $50,000. You're carrying a $40,000 balance. Or let's bring it down. You already have a balance with us at 8%. Why do you need more credit lines? Versus if I drop it to zero and I'm not carrying the balance and then I go back in with them, they're going to say this person is responsibly using their credit exactly like they need it. Now, you can use this scenario in the personal side and on the business side as well. Second thing that this does is that this creates a good overall debt management system. Because I don't know about you, I don't like to live off of spreadsheets wondering, okay, did I pay this card on time? Did I not pay this card on time? Okay, let me carry 2% on this one. Oh, wait a minute, I'm going to 8%. Let me carry it off. If you can pay off your debt on time every single month and not have to float a balance, 100% do that. You're going to sleep better at night and you're going to make good financial decisions. Some of the best clients that we have, again, have multiple six figures of funding per LLC. And these guys and gals do not like to carry balances. They are paying it off in full, but they have available credit lines at their disposal, locked and loaded, ready to go in case they need it. This next one is a big misconception that I see. We actually made a video on this that went kind of like semi-viral a few years back, but I wanted to provide a little bit more color on this because I think by looking at some of the comments, some of the people got kind of like lost in there. And so this does not automatically remove, paying off a collection does not automatically remove a collection off of your credit report. I'll say that again. Paying off a collection does not automatically remove a collection, a charge off, a bankruptcy, a repo, insert credit card, loan, student loan. It does not automatically remove it from your credit report. This is like, I know this is a weird analogy, but I love fitness analogies because obviously we're all mind, body, spirit, right? This is like checking your blood right after working out and then thinking that if you suffered from hypertension or if you suffered from, diabetes or have a bunch of sugar, that all of a sudden it's just magically gone, right? It's a process. It's a process. The inverse of that is like, this is like checking your blood after having a big old slice of cake. Probably not the best time to do it, right? And so you would need what's called a pay for deletion agreement. A pay for deletion agreement or pay for delete agreement, the other way you said, is going to allow you to have a contract set up with either the original creditor or at this point the collection company, if that's the route that you wanted to take. Although you're able to remove it without having to pay for it. I'm just saying for those of us that want to pay for this stuff, right? This is going to allow you to get it removed off of your credit because now there's an agreement. So if I send you $500 and let's say the total debt was $1,000, but we agreed $500 not to settle, a $500 for a deletion, then when you go to look at your credit the following month, that collection should come off of your report. If not, you can go ahead and file the dispute against it based off of the evidence that you have, which is the pay for delete contract. Collection, the second way that this can happen is collections land outside of the statute of limitations. That's the other way. So if maybe you're in a state where a collection shouldn't be there, it's been over 5 years and it's still reporting, then at that point you can go ahead and start or continue the dispute process. No, that's not going to start the clock over. That's how you would want to do it. Whether it's a factual dispute or some people like Metro 2, or if you're making a complaint with the CFPB, whatever that is, that's the route that you would want to take. You end up, if you decide to pay for this and you don't take the proper steps, you end up with what's called settled for less than on your credit profile. Now, there's two schools of thought here that I want to share with you. Number one is if it's settled for less than, we're seeing that some people, not all, this is again case by case, are still able to get access to personal and business credit lines because some underwriters are saying, okay, it's set up for less than, that debt's already been over 4 years, and so it doesn't carry as much weight as maybe a brand new collection that just hit the account. We'll go ahead and approve the file. The second route, or the second thing that happens though, is that some underwriters, especially like if you're buying a home, especially with the mortgage, they don't want to see for settle for less than, especially if your DTI is like right there. And so sometimes they would actually want that off of your credit profile completely. And so this is why I mentioned just because you made a payment to a collection or just because you made a payment to, bring the account back up to date, that doesn't necessarily make that go away. You also have to take additional steps to get it removed off of your credit profile. Next myth is higher scores are better. I hear this quite a bit where, Irv, the higher the score, the better it is. But here's the issue with that. Credit scores alone don't tell the full story. This is kind of like just looking at someone's weight. And so here goes another fitness analogy. So if you have a 175-pound non-active person, right? Maybe they're like me, just sitting at a desk, right? Even though I like to get some, some weights lifted from time to time. And then you have a 175-pound professional football player from the NFL, not soccer, from the NFL. Those are two completely different types of body compositions, endurance levels, stamina, strength levels, the whole 9 yard. Even though on the scale, if you were just to look at the number, they're both 175. It doesn't tell the full story. And so the way that this ties into your credit is you have two people, one's 775 and the other is, let's say, 775, the way that the banks and underwriters look at it is they're going to want to see what's on the report, because that is, again, the blood work that we have to look at. That is, hey, let's put you under a stress test. Hey, let's go ahead and have you run on this treadmill for 8 minutes, see what your cardiovascular conditioning is like. Hey, let's see how many times you can rep this squat, 225 on the bar. Let's see how many times you can rep that out, right? This is why you want to focus on the credit report and not just what we call like the vanity metric or the surface level metric, which is the credit score. Credit score is just going to be a byproduct of your credit report. And so you want to look at primaries, remember, no less than 5. You want to look at the age of the credit if you want it to be optimal, over 5 years old. And then you want to look at the usage, no more than 20%. Anything over 30, that's when you start dropping. So let's say you have $100K worth of personal credit lines and you used up $90,000 worth of it, then you're probably going to be in the low 600s. Now, the opposite side of that is if again, you're 20%, only 20K is used up, you have 80K available, you're probably be in that 730, 740 range, assuming everything else on your profile checks out. Here's one last thing that I want to debunk, and this is like a bonus. Having a 790 credit score doesn't get you access to cheaper or more money. 790 plus credit score doesn't. That range is right around 765, 770 to right around 790 is essentially going to be it. Anything in the 800s, there's, at this point, I'm going to call it a diminishing return. If you want to shoot for the 800 club, by all means, just know that you're not going to get quote unquote better deals, better options past 790. You're going to get what you're going to get. And so if you're going to focus on, any metric, again, assuming the credit profile lines up credit score wise, that 765 to 790 is where you want to be. And lastly, if you are someone that you have maybe a 700 credit score, or actually I'll bring it down some, a 600 credit score, and you think that just opening up an LLC, having a 70 paydex score, 10K in the account, you're just going to walk into a bank and you're going to get approved for a business credit line, you are sadly mistaken. Here's why. Credibility for the business starts with the owner or owners first. That is always the first place that the banks are going to look at. The underwriters in the banks understand that your personal credit is going to be the longest track record of how you've been managing debt. And that's typically going to be a key indicator on your debt management skills and also your debt behavior, which again goes back to our previous slide, which is your credit profile. That's all they need to see. If they see this person is notorious for carrying high balances, this person is notorious for missing payments, you may be a great person. You may go to church on Sundays. You may feel like you have a life-changing business idea, and I'm with you. Like, I'm here. I get it. But that does not matter to the underwriter. What matters are the metrics on that profile. And so even if maybe you went through a tough spot when you were younger, get it cleaned up. Get it back up to date. Because that's going to be the first lever that they're going to look at that they can pull out on their side. That's going to be a yay or a nay for business credit. Personal credit sets the baseline for business credit. This is the other thing. Apart from you getting approved or denied, because it's one of the first indicators that they like to see, this is going to set a baseline, which is typically 3 to 7 times the amount of your personal credit account, which is if your highest, let's say, account is, I'll give you an example, 10K, then you can expect to get somewhere between $30,000 to $70,000 of an approval for that same trade line, but over on the business side. Personal credit is going to be a good primer. Like, don't disregard it if you are, someone who's looking to transition from, just using your personal funds, just using your personal credit over to the business side, which is why I left this piece for last. Don't disregard and don't think that, once I go into business, I don't need personal credit. Once I go into business, my personal credit, it's like, I'm good. I have my LLC. No. Still focus on the personal credit. Number one, it's going to be a good primer. Number two, it serves as a good bridge and a data point that the banks use for you to establish a partnership, a relationship with them. And one of the things that they use, apart from looking at your bank account with them, they also like to see Does this person have any other products with us? Guess what? That's going to drastically increase your approval odds versus somebody who's just coming in cold turkey, assuming everything else is lined up. So there you have it. Those are the myths that I wanted to essentially debunk, that I see a lot of people talking about, and I just think it's a load of nonsense. So hopefully we were able to put a little bit of color in there, shed a little bit of clarity, and hopefully you're able to find good use of this information. If you are a small business owner or a startup and you're looking to get access to working capital, want to jump on a call with you, we can set up a call with my team, see where you're at, how much capital you're looking to get, and see what's working or what's not working in your business. Essentially, what we do is we build out business funding systems that we install into our clients' businesses so that they can predictably and sustainably scale their working capital and continue to grow their business. If that's at all interesting to you, go ahead and click the link below. We'll have it pinned as the first comment and in the description, insideinnercircle.com. I will see you guys on the other side, and I will see you guys in the next video. Bye.